Hello there, everyone. Welcome to Solutions, Not Just Problems. We are your hosts, Vanessa K. and Be Real. Be Real, how you doing today?
Hey, another busy Thursday. A lot happening, as you know, with BSM, Brand Strategy Marketing, SNJP.
You've
We
been down under. Like, not.
Yeah,
Did you
yeah,
even eat today?
yeah. I had a little something. I'm on a pretty good schedule here. I'm trying to just do 3 meals a day and no sweets. It's allowed me to lose a couple pounds here or there. As a result. So.
Well,
You know,
good deal.
still on the weight loss kick, trying to drop about 10 pounds. We'd be surprised at how much different we look, just losing even 5, 10 pounds sometimes. You know what I
Oh,
mean?
yeah, it makes a difference. And in your energy level.
Oh,
Like five,
absolutely.
10 pounds, energy comes back. And
Yeah, I don't know what your thing is, but mine is sweets, And sometimes at night, because I'm a late night person, I can be up sometimes till, 1, 2 in the morning and just working on something or watching TV or whatever the case might be. And if
yeah,
you're up late, chances are you're gonna eat a little something.
it's
So
that late night
yeah,
eating.
yeah.
I'm not so much sweets, I'm more junk. Like, I'll
Mm,
eat those French fries all day long. I'll
yeah.
go get that burger and eat that
Chips
Whopper
too.
at 12 o'clock at night.
How
That's
about the
that's my
chips?
problem.
How about the chips? Lay's,
Oh,
Doritos.
the Lay's, the Lay's. It gotta be Lay's. And I will go, and here's the sad part. I'll go through a bag of Lay's.
Oh no,
Not
I
the,
haven't
the,
done
the
that.
one bag, the family size
Listen,
bag.
this is a PG show, so we're trying to
The super duper bag. I'll sit there all
look,
night and eat that.
folks out here. This is a family show, so we're not trying to, let your kids think that it's okay to eat
It's not okay to eat a whole bag
and
of Lay's. Especially after
wow.
6 o'clock at night, okay?
Oh, that's crazy. That's crazy. Listen.
Well, last week we spoke about the basic steps to take when filing your taxes.
Mhm.
Today we're going to look at taxes from a different perspective, utilizing the tax laws to plan your future. Believe it or not, when done correctly, taxation can have a positive impact in growing wealth and retirement accounts. But before we dive into the show, we're going to take a quick break, so stick with us.
At BSM, we transform ideas into results. With high performance websites, strategic digital marketing, and intelligent business solutions, we help brands stand out and scale with confidence. Ready to elevate your brand? Let's make it happen. Visit brandstrategymarketing.com today.
Be real. The word planning implies there is some sort of future outcome one is trying to obtain, right? When it comes to tax planning, what are a couple ways an individual can stay ahead of the planning curve?
Hmm. To me, one of them from a tax perspective, and then we're going to talk a little bit about kind of like from an investment standpoint. But from a tax perspective, I would really sit down with whoever prepared my taxes, especially if you have like a CPA, okay, and come up with some kind of strategy as to how you can minimize the tax burden moving forward. Some of the things that you can do on your own is look at your previous tax returns, maybe the past 3 years, okay, and see where, because it's not that difficult to, go over a tax return and see where you could maybe increase some of your expenses or decrease some of the income, okay. And what I mean by that is, uh, especially from the income decreasing standpoint, you may have some deductions that perhaps you weren't taking advantage of, like depreciation on equipment. It could be something like you didn't include your cell phone bill, or you weren't tracking your mileage. Keeping track of the from the expense side. Okay, and that's mainly from the tax perspective. Now we're talking about actually preparing from an investment side. One of the things I would do is to make sure that your W-4, okay, is set up properly so you're paying the right amount in taxes, okay, every single year. Because what I find is that some people are left with a tax penalty or they owe taxes when in fact they should be getting to the point where the objective is to break even. Okay.
Mm,
So what you should be doing is to make sure that you're contributing at least, let's say, 10 to 15% on the federal side, okay, especially of whatever your taxable income is for that year. Okay. And depending on what tax bracket you're in, which is a whole different thing you need to look at because you can be anywhere based on the new Trump policy, you can be anywhere from 10 to 37%. Okay.
mm.
In terms of your individual taxes. Um, but when I was talking about putting aside that money, it's making sure that when you look at your W-2, not your W-2, I'm sorry, your statement that you get every week or every month or whatever the case might be from your job, making sure at least 10 to 15% is allocated towards federal taxes and somewhere between, let's say, 5 to 8% is allocated towards state taxes. Okay.
And does that apply the same with the business owner? Like if you run your own business, should you be using that same them same percentages?
Yeah, because most of the time, what happens is whatever you have from the business side is going to be transferred over to the personal side. So, from a business perspective, I don't do any type of business returns. Okay. And that's something that's a little bit more complicated. It's more like towards what a CPA would do. But when you
Mm,
talk about someone who just prepares individual taxes, yeah, the income that you have from the business, which is, if you look at it, is on a Schedule C, okay, is transferred over to the personal tax return. Okay. So someone like ourselves who has like an LLC or you're a sole proprietor, or your corporation where the income is now allocated or sent to you, you're going to be responsible for paying taxes on that, which means now you also need to be responsible for making sure that you're doing the proper planning.
so let's talk about the tax bracket. We hear that often, tax bracket. What does that mean in layman's terms? What is a tax bracket?
It just means the percentage of taxes you're going to have to pay depending on the amount of income that you have as an individual or as a married couple. Okay. Now, it's very complicated, and I just looked this up before I came here because I had to make sure that I was on top of it. But there are actually seven different tax brackets, and they range anywhere from 10 to 37%. Oh, man.
Oh, wow.
Huh?
Oh, wow. So the
Yeah,
tax bracket is based on your income, though, right?
yes. Now,
Okay.
if you make 20 grand, 30 grand, chances are you're going to be on the 10% bracket level. But now, once you start getting above, let's say 90, 100 grand, now you could go from 10%, let's say anywhere to 20%.
Mm,
Now, there is an actual amount, and it's well over $500,000 where you're paying the 37%, you're in that 37% tax bracket. And I just realized this by looking at it because keep in mind it just came out in July. It
mm.
came out this month, the Trump tax plan. So
Oh,
moving
yeah.
forward, yeah, moving forward, you've got to be careful when you're making or you have income, okay, and you're getting to a certain point because you might make 90,000 and be at a 22% tax bracket, but when you go to 110, you're now at a 32% tax bracket. I'm just giving an example. I'm not telling
Oh,
you.
so those are the ramifications
Right.
of getting into the higher tax brackets,
Yes,
actually
yes,
paying more.
yes. So when you have things like distributions from 401ks, money that you may have received from an inheritance or from, certain property, it gets involved. So,
Mm,
you could get stocks or bonds that were you've inherited over a period of time. You'd be surprised at all the different things. Oh, an inheritance from a parent or perhaps a spouse who passed away, who now you're getting their 401k.
yeah.
403b. I've seen that happen on quite a few instances, and people think, "Oh, I'm just going to go and take the money out." Okay, that's not how it works.
Mm.
Because if you're not of a certain age, which last time I checked was around 60 years old, I think it's 59 and a half. Don't ask me how they came up with that number. Okay, not within a certain age, guess what? You're not only hit with the taxes for it, but you're also hit with a penalty.
Oh, wow. So you really have to stay up on the tax law and
Oh
know
yeah.
this stuff.
Okay. So
Be careful on those gifts and inheritance, huh?
yeah,
It feels
yeah,
like a gift when you get it, and then wham,
yeah,
end of the
yeah.
year.
And that's something that we need to understand that when you're getting money, 9 times out of 10, there's probably going to be tax ramifications, uh, or or we call it consequences, and you need to be aware of how to handle that income.
Mm,
Okay. Now, understand one thing: you're taxed on the income that you receive in the previous year. In other words, anything that you make between January 1st and January 31st is going to go on your 2025 tax return next year in 2026.
right.
Okay. So if you made that money in January on January 1st of 2026, guess what? The year that you earn the money is the year that's going to be taxed on. So if you earned income in 2026, that income is not going to be taxed until 2027, but it's for the tax year of 2026.
2026. That's correct, right?
Okay. I know I went on a little rant, but when you kind of one thing kind of leads to another, let's put it that way.
Okay.
All right.
What about retirement contributions, right? What are
Ooh.
some of the most popular, commonly used retirement
Yeah,
accounts?
yeah. There's three of them that most people are using. That most of my clients have used anyway. I'm not an investment broker, but you have your IRA,
Hmm.
which is basically a Roth IRA, and you have what is called a traditional IRA. The biggest difference between the two is a traditional IRA, the money that you contribute towards that IRA, and it could be 5,000, 10,000. I believe the maximum might be about 50,000 for individuals. And I forget what the maximum amount is for couples, but it may be double that amount.
Hmm.
And like I said, it changes every year. So we really got to check to make sure, not every year, but it changes every time there's um, uh, uh, a new tax cycle or a new president comes in, they change the tax laws. We got to be aware of the fact that things can change.
Right.
Okay. But getting back to what I was saying, you've got an IRA, which is a traditional, which means that anything that you contribute, you can deduct from your taxable income. Okay. So let's say I made $50,000, I contributed $5,000 towards an IRA. I'm able to deduct $5,000, which means I'm left with $45,000 I got to pay taxes on.
Mm,
Okay. That lowers my taxable income. With a Roth IRA, what happens is the money's not deductible on the front end, but guess what? It's not taxable on the back end.
mm.
When you take the money out at 60, 65, whatever the case might be, you're not going to be taxed on it. Okay, so those are the big difference between the Roth and the traditional. I'm sorry. The next is what is called a 401k, which is mainly an investment plan that you have through your employer that you can use to put money aside towards retirement. Okay, we used to have pensions. Okay, pensions were replaced during the Reagan years with these 401ks and what I'm going to talk about next, which is called a 403b. Now, with the 401k, the main thing you want to do is you want to try to max it out as much as possible, especially if the employer is matching. Okay,
So when you say max it out, what do you mean? Like your
so
contribution
maximum amount that you can
can
contribute,
contribute? Okay.
and here's why: it reduces your taxable income. Okay. So once again, let's assume that you made $5,000. Okay. And you contributed $5,000 towards your 401k, right? That income is excluded from your taxable income. So if we just took that IRA we had, let's say you had a traditional 5,000 and then you had a 401k, right? Of 5,000. Now you're looking at $10,000 being deducted from that 50 grand, which means you're only paying taxes on 40,000.
Gotcha.
So you see how this tax planning can get you to the point where, yeah, you may have a little bit less income throughout the year, but you're paying less taxes, number
You're paying
one,
less
and
taxes.
you're putting together an investment strategy moving forward.
Makes
Okay.
sense.
The
Yeah.
other thing that is similar to a 401k, but it's a 403b, is what is for nonprofits. So you have the 401k, that is for the for-profit companies, okay? And you have the 403B, which would be like for a company like United Way, who has a
Gotcha.
501(c)(3). They fall in that nonprofit status, and they'd be able to offer you that particular investment opportunity. Then there are some other opportunities that you can do if you are a business owner, such as us. There's some investment opportunities, and I would suggest that you sit down and you talk about that with your financial planner or perhaps your accountant to see what things are available and kind of set that up because that's a little bit more intricate and a little bit more involved. So,
Absolutely.
yeah.
Absolutely. So in terms of contribution amounts, I'm going to shift a little bit, right? When
Mhm.
someone's deciding what should I put in my 401k or what should, well, I think there's a cap with your 401k, but with
Yeah.
your IRA, what should I contribute? Why does age in your future goal? Well, we already talked about future goals, but why does age make a difference? This is
Oh,
for audience who doesn't know this. Age makes a difference when you're talking about contributing, right? It's going to determine how much you contribute.
yeah, yeah. As you're younger, you can be a little bit more riskier and maybe not quite as aggressive in terms of putting in. And like I said, I am not an investment broker. I am not someone who is licensed to give information about investments. I'm just telling you based on the knowledge that I have, and things that I've done in the past. Okay. When it comes to actually investing, when it comes to age, as you're younger, you want to be take on more risk, but you also don't have to be quite as aggressive in terms of the contribution that you're making. Okay. As you get older, you've got to probably speed it up a little bit. Let's say you're over 40 years old, you've got 25, 30 years left before you retire. Now you probably have to contribute a little bit more. Okay. But you might not have to be as risky with it. So you're not worried about getting those huge returns.
Right.
Okay. That's the biggest advantage.
Yeah.
And let me just say this. I meant to talk about this earlier when the light started flickering. Okay. But
Technical difficulties.
I got the
The
I got the
typical
I got
day.
the yeah, I got the flicker over here. But let me just say this. One of the main things besides that tax deduction that you're going to get, uh, why you should contribute towards your 401(k) or 403(b) is the contribution that's coming from the employer.
Hmm.
It used to be when they first set it up, a lot of companies were doing dollar for dollar. So if you put in $5,000, they put in 5,000.
Hmm.
Okay. But a lot of companies said, for every dollar you put in, we'll put in 50 cents. Okay.
Right, right,
And contribute quite as much.
right.
So if I'm getting dollar for dollar, I'm putting in the maximum amount of money that I can because now come retirement, I might have a nest egg of $3,000, $4,000 put aside.
Hmm.
I'm sorry, 300 to $400,000
Right, 'cause I was
put
gonna say
aside.
that's not a big nest egg
No,
for
no, 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 no.
$3.
Yeah, or in some cases, $3 to $4 million.
Yeah,
I literally
yeah,
know people right now that have over $1 million in their 401(k).
yep.
Okay. Um,
Yeah, I
so
just wanted to say that because some of our listeners, some of us aren't even set up with that yet. And if you're coming on 40, 50 years old, you have to be a little bit more, your contributions need to be a little bit more aggressive.
yeah, let me just tell you though, Vanessa, 9 times out of 10, when you're setting up your health insurance and you're setting up, vacation time, you're doing all that stuff during that fiscal cycle. You know what I mean? When your company kind of starts over and you got to choose a new plan, the rates are going up, blah, blah, blah. 9 times out of 10, they're going to include it. You being an HR person, you know
Hmm.
that there's going to be a certain time every year, that the company is going to have an opportunity for you to be able to invest. Now,
Right,
what a lot of people say is, I don't want none of that stuff. Okay, you're getting older now. You're over 40 years
right,
old. You need to start thinking about this.
right.
I'm gonna tell you right now, I would say the age you want to start this, minimum 25 years old.
So I was thinking 18, as soon as you get your first job,
Yeah, no, I'm not
a
saying
real
minimum.
job, not
No,
a
no,
restaurant. I'm in high school,
no.
I'm in college, but
Yeah,
when you get your first job,
yeah. Well, I think the reason why I said that is because I was assuming that most of us get our first job around 25 to
20,
30
25,
years old,
yeah.
to where you're really making money where you can contribute and it's not really hurting your pocket.
Hmm.
know what I'm saying? But of course, if you're the type of person, you get out of high school, you're doing some kind of technical program, or you just or you got some kind of technical skill, or you just landed that great job, and you're making 70, 80, $90,000 a year. Yeah, of course.
Well, the
You know,
entrepreneurs that are coming out. I mean, these younger people are starting to build their
yeah,
businesses, and they need to pay attention to that.
yeah. And a lot of us don't understand how important it is for us to plan ahead. And I've got too many clients that come to me, be like, "Oh, I meant to do this. I'm gonna do it next year." Well, you've been saying for 10 years you're gonna do it next year. So you know
Right.
what? Let's not have this conversation no more. I'm good.
It's like us in the diet.
No, I mean, I'm
I'm gonna
good.
start my diet tomorrow
Yeah, I'm good.
when I wake up.
I'm good. And you know what? Start your diet, get it done. When it's done, let me know.
Yeah.
Even me, I had to get to the point too. I'm trying to lose 10 pounds. I'm trying to lose 5. Man, but it's
Right. As you're sitting there watching TV, I'll start this
yeah.
tomorrow. Eating
No,
those chips.
Like I said at the beginning of the show, I'm chilling with the sweets, you know,
Yes.
and that is a kick. 'Cause now you're looking at eliminating, 700, 800 calories a night. You know, you know what I
Okay.
hear is really
Well,
good. You know what I hear is really good though,
what?
and I've been doing this too. Is watermelon.
Oh,
You
that's
know,
the best.
yeah,
And it's
watermelon at
cold
night.
too. Oh,
Yeah,
that's the
watermelon
best.
at night is to replace that or a little tablespoon of peanut butter or maybe a couple of Reese's cups or something,
Yeah. Yeah.
to keep yourself because you're only talking maybe 100 calories. You
Okay.
know,
Macadamia nuts. We're gonna give
They-
another tip out here. The
they're addictive
macadamia
though.
nuts reduces the sugar craving. So if you're having
Oh,
sugar
okay.
cravings, throw up a couple of macadamia nuts in your mouth, and you'll be good. You'll get through the
And
craving.
can I tell you something, people? We do shows on top of shows on top of shows. We get off topic. We go into different stuff. We will go into weight loss. We'll talk about what, what you need to do to
Six at best.
check the pressure on the tires. You know what I mean? So, 6 at best. See? By the way, we're going to be coming back too a little bit later on.
We're coming back.
Yeah, we're coming back and we got some stuff for you. This one's going to be a little bit heavy for some of y'all, but we'll be back.
That's right. All right, with that, we're going to take a quick break. So don't go anywhere, people. Viewers, fed up with the constant stream of problems on social media without any real solutions? Check out the Solutions Not Just Problems podcast. They cover everything from relationships to current events, trending topics, business, professional development, and much more. They talk about us. Tune into the SNJP podcast Thursday mornings at 10 a.m. with co-hosts Vanessa K and B Money on YouTube. If you have something you want to talk about, they want to hear from you. So connect with Vanessa K or B Money today. And if you enjoy the show, be sure to subscribe and share. Welcome back, everyone. We're talking about taxes and how we can benefit from planning ahead of time. So another way is to use tax advantage accounts. Let's talk about those. What are some types of tax advantage accounts? Be real.
Oh, of course, you got your flexible spending accounts that cover out-of-pocket medical expenses, daycare, and transportation. And let me ask you a question. Have you used any of these accounts
Absolutely.
in the past?
When I was in corporate America, I lived off
Yeah,
of that flex
yeah,
spending account. I
yeah,
love that account.
yeah. And it's been a while for me. And I remember, being able to set that up so you're able to purchase all
Oh,
different types of stuff,
yeah.
But I remember, because it's been 11 years since I worked for an employer now. And it's a little different when you're on your own, as
Oh,
far as
yeah.
is concerned. You're not dealing with
You
it
don't get
quite.
that benefit.
Yes, yes. So my question is, because I remember back in the day, is it still where you have to spend it? Okay, so if you put that money aside for one of those programs, either for daycare or for what's the other one? Medical reasons,
Medical,
medication,
mhm.
eyeglasses, all that type of stuff.
The out-of-pocket cost. Yeah.
Yes, yes. Do you have to spend it all still? Because
I'm not sure because I
I
haven't
remember,
been in corporate America since
yeah,
2021.
that's one of the things you
But
got
it
to check
was
out.
you did lose it.
Yes,
And what it
yes.
does is it causes you to plan. Like you literally plan. You sit
And
at the beginning of the year
yeah, this
and you
is
have to plan out those out-of-pocket expenses,
this
right?
is where planning comes in, folks.
Exactly.
It's sitting down. Excuse me, and I tell people all the time, stop waiting until April to talk to your tax professional.
Hmm.
You should be talking to them at some other time with a consultation doing what we're talking about right now, which is tax planning. So if you have something where you're undecided as to how much money you should put aside for maybe daycare or how much money you should put aside for some of your medical expenses, talk to the tax professional so you can kind of sit down and come up with a strategy or a plan.
Right.
You know, we're waiting until March, April for us to gather all this information. No, you should have all this together so by the end of the year, it's done.
Right.
And that's what this is really about. The last two series is us being able to prepare, okay, as far as getting our taxes done and also getting to the point where we're creating strategies where we're not paying as much, okay, come March or April, trying to
Hmm.
minimize that tax burden. Okay.
Absolutely.
The other thing too is the college savings plan, which is the 529 savings plan. And I would be interested, when we start having an audience, I'd be interested in as to how many people actually take advantage of this.
Well, I got some feedback on that. And this,
Okay.
again, is back in the day. It's not current, so
Okay.
you can't hold me to it. But one of the negative points on that or the cons with that is, we plan, we get this 529 savings plan. And then
Hmm.
what happens when the child doesn't go to school?
Ooh,
Lose that money or
ooh,
what
ooh.
happens to that?
Okay. I got one even better. What happens when AI takes over the world? You no longer need college anymore. What's going to happen then?
Right.
Just kidding.
Right, and I've
No,
heard parents say that the child didn't even go to school. So
yeah.
how can you convert that money over? I mean, what happens with that money?
To be honest with you, I think you can withdraw it, but like with anything, there's going to be some kind of a penalty.
Tax penalties.
Yeah, yeah. You can't say, "Oh, I'm going to go buy a Lambo," or "I'm going to go, get the new Range Rover when that comes out with that money." Okay, you can do that.
Hmm.
You know what I'm saying? But you best believe you're going to have to pay taxes on that income.
Yeah,
You
yeah.
know, so it is specifically set up for you to be able to use it for college expenses only. Tuition, room, board, things of that nature.
You know what they don't have now that they used to have was the Christmas clubs. Remember the Christmas clubs?
Yeah, yeah,
It would
yeah,
start in
yeah.
October.
Listen,
You
listen,
put your money aside for that.
listen. I'm gonna tell you, you're dating yourself, but I'm gonna tell you right now, my mom was the queen.
That's right.
No, 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 no. I'm gonna take it a step further because we just spoke about this. My mom still has a Christmas club.
Do they
Okay.
still have them things around?
Absolutely. Well, they don't necessarily call them Well, I don't know if they call it Christmas, but they have that savings where they can take out $20, $30 a week or whatever. And then when you
Yeah.
look at your account, and come December and you got an extra 2 grand sitting in there, you're like, oh, okay,
We had big Christmases off of that.
okay,
Okay. And it
okay.
was such a
Listen,
convenience because you're only putting away a little bit a month and they
listen,
would
that,
always cut that check in October 31st. So by the end of November, Christmas shopping was done, right?
see, leave it to a mom, leave it to just some of the old school professional over here that's going to give you another added
That's right. Get a
with
Christmas club if
Christmas
they still have it.
with the Christmas fun. Oh
That's
my
right.
goodness.
Never go without Christmas. Kids never go
Man,
without Christmas.
listen, this is what happens when you're a mom and also I'm pretty sure your mother had one back in the day, but you knew if you putting that little money aside, like I said, $30, think about it like this, 52 weeks in a year, right?
Yeah,
$30 a week. That's
that's a lot.
$1,500.
Yeah. Because think
Okay.
about it. What it was, what do we do? It creeps up on, we know Christmas is every year, right?
Yeah.
It somehow it always creeps up on us, right? Oh my
Yeah.
gosh, I gotta run out and do Christmas shopping.
Yeah.
So it takes that burden away from you. That was the best thing since pants with pockets, that Christmas Club money.
And now I can get the GI Joe with the kung fu
Right.
grip. So, hey, that's the only thing I ever wanted was the GI. Once I got that, I didn't even need no more Christmas. I was done.
Exactly. Another component that goes into planning is tracking and claiming deductions, right? Last week we defined deductions.
Mhm.
Let's review some of those deductions. We talked about business cost,
Yep.
like equipment, systems, training, if you own a business. Charitable donations can be deducted.
Mhm.
Work-related expenses, mileage, food, all of that type of stuff. What are the benefits of tracking and producing these expenses at the tax filing time?
Oh, it just makes the tax preparer's job so much easier, you know? And not only that, if I got to go through all that stuff, it's going to cost you.
Oh, yeah.
You know what I mean? So let's say I'm charged a couple of hundred, normally for, and I'm just throwing out a figure, for tax preparation. And now you come and you bring, all these numbers all over the place, or better yet, an envelope full of receipts.
What about a shoebox?
Okay, we got to, you can bring the shoebox. That might be an extra deuce.
Yeah.
And you might have to pay $200 extra now as a
Uh-huh.
result of that, because now you're asking me to do more work.
Yep.
So the easier you make the job for whoever's preparing your taxes, the less it's going to cost you and less of a headache that it's going to be.
Right.
Okay. So what I would suggest is that you create the old envelope process, and you can do what I'm sure Vanessa does, which is create folders on your computer.
Oh, the
Huh?
drives.
She's the drive queen. And what we mean by that, folks, is that the Google Drive queen. She has everything set up that you would ever want to be able to do when it comes to business and what
That's
have you. So I'm
right.
sure,
All in
sure
order.
you, absolutely. I'm sure you got the same thing when it comes to your personal and making sure all that stuff is taken care of.
Oh, well, a QuickBook app, can track
See,
everything. Now it's
yes,
digital,
there
you
is there
can,
is software out there. Yeah,
it's software, it's
yeah,
reasonable. And you can attach it to your accounting or CPA. You can just send them the software, right? And they can
yeah,
tap right in. You can connect it to your bank account, your
yeah.
credit cards, all of that. So it tracks itself, your spending tracks itself.
Cool.
All right. So managing capital gains and losses. What are capital gains?
Mm. Well, a capital gain is normally when you made money off of selling some kind of an investment product. Is that what you got down? Because you caught me off guard with that
Eh,
one.
Yes,
So
it's
anytime you sell like a stock
uh,
or
real estate.
yes, yes,
You're paying money on, I think there's a
oh,
cap, I think it's
yeah,
250,000. Anything over that, you're
yeah,
paying the tax
yeah.
on the asset over that
It,
amount.
it it can become a little bit involved because now you have what is called basis. Okay. You could have something where you are looking at what the person paid for it, but then any additions or improvements to that asset, okay, is now going to bring the value up. So now, even though you might have paid $10 for it and you sold it for 100, doesn't necessarily mean you're going to have to pay taxes on 90, as the investment grows, what ends up happening is whatever you sell it for, chances are the tax burden is going to be, reduced a little bit. And there's a thing called capital gains tax, that you also
It's you're
have
paying
to
on the amount
have.
over. There's a percentage, a dollar amount. So if you're single and like I know in real estate, if you're selling a piece of property and it's over 250,000, you're paying the capital gains on anything above the 250,000,
Okay,
right? If it's
what was the percentage on that? Because now I'm looking, they just reduced the capital gains tax. And I think it's around 15 to 20% in that range. And I think under the Biden administration, it might have been around 20, 25%.
mm,
I didn't have the figures. I apologize. And the reason why I don't do a lot of research with stuff like that is because stuff changes all the time. And sometimes
right.
information can be inaccurate. So rather than me spitting out a figure, I'd rather just say, hey, ask your professional, or you can do a Google search and find out for your particular situation, because everybody's different. Because
Yeah,
we're talking about gross income and then also all talking about net. Okay, we can be talking about a stock, or then talking about a bond, or talking about real estate. So it can vary depending on where you are with it, what the basis is on the account, um, how much you sell it for. All that comes into play as to what you have to pay as far as taxes are concerned, and what they call a capital gains tax.
So when we're talking capital gains, taxes, it's a little complex. So our
Yes,
advice is
yes,
to
yes. And even
talk to
my
your tax
explanation,
professional.
even my explanation was complex, and I started
Right.
thinking
Not applicable to us.
and started saying, okay, is this too much? Am I going in circles there? But yeah.
We're going to take a short break. We'll be right back with more. Dreaming of a new beginning? Finding the perfect place or getting your home sold at the right price can feel overwhelming. Call Vanessa Kay, your local real estate expert. Understanding that buying or selling a home is a big decision, she'll guide you through every step, from finding the home suited for you or advising on how to price your home to negotiating the best deal. And it all starts with a free consultation. Why not schedule yours today? Welcome back, everyone. We're going to wrap this session up with when do we need a tax professional? Be real. Can you let us know when we need a tax professional? What are some indicators that will tell us that we really need to speak to a tax professional?
Okay. The beginning, at the very beginning of today's presentation, I kind of touched on something, and that is if you have more than W-2 income, chances are you need a tax professional. You know, if you're over the age of, let's say, 25 years old, chances are you probably need a tax professional. Okay. But specifically, you need one if you're opening up a business. Okay. You need to speak to somebody about uh, what type of corporation you want to set up. Okay. And there's Schedule C. I'm sorry, there's an S Corp, C Corp, LLC, sole proprietorship. You need to sit down with a professional to find out what's going to be to your advantage. Because a lot of people just go out and set up an LLC, and I really, be honest with you, I thought that was a good thing until I learned that an LLC is not always the best one for you to get into,
Mhm.
depending on the type of business, the type of structure, what you're trying to accomplish, uh, whether how you can actually lower your tax burden, setting up a different type of structure. So it's not something where you just want to rush out and say, "Oh, let me do this here." Now you
Or
need
there's
to
additional steps with an LLC that we
exactly,
kind of don't do. So, yeah.
exactly. Um, Marital status change. Okay. And anytime I see where people are combining incomes, okay, you definitely need to sit down and talk to somebody because that is going to change everything dramatically.
Mhm.
Change your filing status. It's going to change your head of household status, or whether you are eligible for itemized deductions anymore, whether you're eligible for the standard deduction, uh, whether you have the personal deduction that you're eligible for in most cases as an individual, um, how it impacts your state taxes, how it impacts the amount of money that you have coming in total, where you shift to another tax bracket. Uh,
Mm-hmm.
I mean, there's just so many different things that you have to look at. Then, if you bring in kids on board, okay, if you have children, now you have certain deductions that you were eligible for, maybe with one income that you're no longer eligible for with two. Okay, so there's just a whole lot that we got to take a look at when it comes to changing marital status. And one of the things I want to talk about real quick is a lot of people when they get married, they want to do this. I don't want to share what my income is. So what they want to do is they want to separate the taxes, and I'm gonna do this over here and you do that over there. Okay, two things that usually happens. Number one, it's probably not advantageous for you to do it because you're going to end up paying more in taxes.
Right.
Okay.
Right.
Two, if you live in a state like Georgia, whatever you do on the federal, you got to do on the state.
Mm.
So if you take the standard deduction on the federal, got to take it on the state. You do the itemized on the federal, you got the spouse has to take the same deduction on the state. Okay. So not knowing about things like this can get you into trouble. So that's where you want to sit down with a tax professional. Um, Purchasing real estate uh, and estate planning, are two other reasons why you want to sit down with a
That's
tax
where them
professional.
capital gains comes in. You
Yes.
want to have that discussion.
Yes. Yes. And that's for another day. And I wish we would have had a professional come on here and talking about living wills and when to sell your property to if you're getting older, or how that's going to impact you from a tax perspective, and that's something for another day when we revisit this topic. We'll come
And
back and
inheriting property.
yes, because
That's
it's
another one.
very
Inheriting.
it's very involved, and like with the laws changing and everything, it's not something that we necessarily want to get into a whole lot of detail about, but just know. And if you're trying to purchase property, or you're trying to do some type of estate planning, or you're trying to do some kind of living trust, or you have a parent who owns property and maybe looking at needing some type of home care or elderly care, you really want to sit down with an attorney or a professional in that area and discuss
Mhm.
from a strategy standpoint
Right.
how to handle that.
Yeah, because you don't want any surprises.
Yeah, I'm gonna tell you what happens a lot of times is people lose their homes real quickly. It
Mm-hmm.
goes real fast. That nursing home money is $10,000 to $20,000 a month.
Mm-hmm. Oh yeah.
You got equity in your house, and let's say you got a $500,000 home, and you think you're going to get Auntie so and so's home, or Ma so and so's house, and you think you're going to inherit it, and all of a sudden she's got to go into a nursing facility. Guess what? If she doesn't have any other assets, they're going to attach it to that home,
Right. Right.
And I'm not going to go into any detail about it, but I'm just telling you that this estate planning, this living trusts, living will, all that type of stuff, the insurance piece, everything needs to be discussed with a professional. Go pay the money to get that
Get
done.
done.
Yes.
Absolutely. Absolutely.
And with that being said, I have nothing else. Um,
No?
and,
Well, we appreciate you today. I mean, you
I
really filled us
apologize
in.
for I apologize for the on and on and some things, but when I get to thinking about stuff, I'm like, whoa, and don't forget about this, and a lot of it is stuff that I've done in the past, or
Absolutely.
maybe I studied, or I have experience in myself, most of it, so I can tell
Well,
you not only from a professional, but also from a personal perspective as well.
I appreciate you. You shared a lot today with us, because I couldn't have done this show or this topic by myself because I'm not the tax expert. I'm kind of, it's kind of like Greek to me, but I appreciate you. Before
Yeah,
we go,
I just want to say one thing.
mhm.
If I got anything wrong because of these new tax laws with Trump, don't put it in the comments. I'm just, no, I'm just kidding. I'm just kidding.
Call me up on the
Yeah,
slide.
yeah. Say what you want. Don't say it's 27%, not nah, I'm only kidding. But go ahead, Vanessa.
Oh,
Pick us
before we
up.
go, we want to reiterate when tax planning, work with your tax professional. Everyone's situation is different. The tax professional will identify your unique attributes and will advise you accordingly. This wraps up today's show. Thanks for watching, everyone. Be sure to join us next week as we journey into the last segment of this series, Investing Your Money. We're going to cover diversification, savings, asset protection, and so much more. You won't want to miss this one. This is Vanessa K and Be Real signing off. And remember, keep growing, stay motivated, and thank you for tuning in.